Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. The channel is almost at 1,000 subscribers. If you have not done so, make sure you hit that subscribe button down below. Help us get to 1,000 subscribers and beyond. On this channel, we focus on dividend growth investing. In my opinion, it's not rocket science. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks in growing companies with positive cash flow that covers the dividend and companies with a high return on their invested capital. I utilize both a dollar cost average approach, consistently investing in the portfolio every week. I also contribute additional funds if I have a bonus or do a side job or run into any extra cash. It is free. I cover all of my investments into the portfolio, nothing to pay for on this channel. I do not have a paid Patreon account. I'm not trying to sell you any courses. I don't have any other sites that I'm sending you to where you have to enter in your credit card. There is nothing to pay for. It is free to see what I'm doing. On this particular video, we are going to cover the $1,706 we added in new capital. And we also did sell out of one position, so we're going to cover the reallocation of those funds into this portfolio. And before we get into the video here, if you would like to help out the channel, if you could do me a favor and hit that thumbs up button down below if you're a dividend growth investor and you find any value in the content, make sure you are subscribed to the channel. Hit that subscribe button. Join us on this journey to financial freedom. Join the Vested Interest community. Over half of you are not subscribed that watch the channel, so make sure you hit that subscribe button and hit that notification bell so you're notified whenever we put out any new content. We do these portfolio updates every Sunday. We also do a stock pick of the day series Monday through Thursday, so make sure you click that notification bell so you can come back and join us for those other videos as well. Now let's get into the meat and potatoes of the video. We will start with options. On July 8th, we did have a couple of contracts that we entered into. As you can see here, we sold to open a covered call on Johnson & Johnson with a 150 strike price set to close on Friday the 12th. It did expire out of the money, right? So it was just under 150. I think it was $149 and some change. So we did receive $21.45 in options premium. We keep the options premium and we keep the 100 shares in Johnson & Johnson, and we could do it again next week, hopefully. I'm not getting a lot in options right now from any positions, really. Been a down year overall for options, but we're still plugging away. And we did have one other contract, right? That's what the one means. -1 means one contract. You have to have 100 shares to do a contract. We did another sold to open covered call with a $32.50 strike price on Kraft Heinz Company. And Johnson & Johnson is out of the healthcare sector, if I didn't mention that. Kraft Heinz is a consumer staple company here. And we received same expiration date, right? July 12th, and that one also expired out of the money. So we keep the 100 shares of Kraft Heinz. We also keep the $11.45 we received in options premium. Total for the week, $32.90. And I will say we threw out about 5 or 6 other options covered calls as well. None of them hit. These are the 2 that we got. So $32.90, and this is part of the capital that we added to the portfolio for new capital. Now, let's get into this one. This is a little bit to go through, so bear with me on this one. On July 10th, again, we did sell out of one position, Sibanye-Stillwater, ticker SBSW. This is out of the material sector. This is a mining company out of Africa. They've been having a lot of troubles. That's not really why I sold them. I still like the company. May buy back into it in the future if it was to drop down significantly or something like that. I just feel like some of these other positions where we reallocated funds are looking a little more attractive, and that is one reason to sell. I know I really need to do a video on when to sell a stock, but there are a few reasons that I want to touch on. If you see companies, right, like this one that aren't performing, sometimes it's better to cut your losses. Or if you see companies that no longer meet criteria whenever you bought them, that's a good reason to sell. Or if you need the funds for other things, life happens, if you have some bills that come up or something like that and had to sell part of your portfolio, that is definitely one reason to sell as well. And then the other reason is there are better opportunities, right? Whenever you have funds in any company, it always comes with opportunity, what is called opportunity costs. That means, excuse me, if the funds weren't with Sibanye-Stillwater in this case, where else could you use those funds? That's the opportunity. So in my opinion, it was better use of capital, in this case the $2,853.26, to spread that out over some other positions that I want to continue to build out And so let's go over that real quick. Again, $2,853.26 is what we received for selling Siboney-Stillwater. We did lose $131.70 in passive income over the next calendar year whenever we sold out of these 592 shares. Now, with these funds, we picked up 60 shares of Vale, ticker VALE. This is another mining company that I feel is a little better suited for long-term growth than Siboney-Stillwater, so I was comfortable plugging a lot of it in there. Picked up those 60 shares at $11.44. We did pick up 10 more shares of Enbridge Inc., ticker ENB, out of the energy sector. This is a very nice energy company. I like this one. This is a limited partnership, so it has a little bit different. I'm sorry, this isn't the one. EPD is. Yeah, so we'll look at that. Enterprise is a limited partnership. And we did 10 shares there as well, also out of the energy sector. But Enbridge is actually a Canadian company, so there are some tax implications there. My brokerage takes the taxes out whenever I buy these foreign companies right away. You want to know if your brokerage does, because if they don't, you'll be responsible for those taxes at the end of the year. In my case, with Ally Bank, they take out taxes right away. Enbridge is an energy company. They are out of Canada. We picked up those 10 shares at $35.71. I will jump down and cover Enterprise Product Partners since we just spoke about it and I got those two confused. Enterprise Product Partners is also out of the energy sector, ticker EPD. Now, this is a limited partnership, so they have some different tax applications. You get a different tax form to fill out and add to your taxes at the end of the year. So make sure you understand the differences in some of these companies. This being a Canadian company, this being a limited partnership, there are different tax implications than some of the other companies in my portfolio. 10 shares of EPD at $29.21 per share. Let's jump back up to Johnson & Johnson. We picked up 2 shares of Johnson & Johnson, ticker J&J, out of the healthcare sector, $148.73 per share there. Union Pacific and Procter & Gamble, the next two are ones we were trying to focus on for this month anyway, so we wanted to add a little bit there. Picked up 1 share of Union Pacific, ticker UNP, for $222.93. 1 share of Procter & Gamble. Union Pacific is out of the industrial sector. This is a railroad company. Procter & Gamble out of the consumer staple sector, ticker PG. Picked up that 1 share at $166.53. We added to our Schwab SCHD position. This is the Schwab Strategic Dividend Growth ETF. We picked up 6 shares of ticker SCHD at $77.53 per share. We already talked about Enterprise Product Partners and Starbucks. We've been growing for a while, or building out for a while. So we took advantage of it dropping back into the $72 range and picked up 6 more shares of ticker SBUX out of the consumer discretionary sector at $72.63 per share. Now, even though we lost $131.70, the offset from all of these new positions actually netted us $17.18 in passive income. So we added an additional $17.18 even after accounting for the $131.70 loss by rolling these funds over. Now, you'll also notice if you do the math here, this math does not quite add up. One of these shares of SCHD here, one of these shares of SCHD is our weekly buys. So this is actually a little bit more. These buys total up a little bit more than the $2,853.26 because one of these SCHD purchases is from my weekly buys, so the new capital added. So 5 of these are part of the reallocated plus the rest of these, and one of these SCHD shares is from new capital. So that's why if you do the math, this doesn't quite add up to what purchasing all these shares would add up to. Now, dividends. So that's the reallocation. We did receive some dividends as well. Very, very busy week in the portfolio. On July 9th, we received dividends from Medical Properties Trust, ticker MPW. This is a REIT out of the real estate sector. And we picked up $166.88 in dividends. We do have the DRIP set, so that means dividend reinvestment plan. Anytime a company, in this case Medical Properties Trust, pays out dividends, in this case the $166.88, it goes right back in and picks up more shares of that company. So the $166.88 bought 40.21205 more shares of Medical Properties Trust, and those 40.21205 shares added an additional $24.12. This is what they mean when you hear people say the dividend snowball effect. So we have already purchased shares of Medical Properties. Those shares pay out dividends. Those dividends buy more shares. Those new shares bought by the dividends add additional passive income, and that snowball gets bigger and bigger and bigger. Even if I don't add any more to Medical Properties Trust, as they pay out dividends, it will significantly increase my position, and it will be even more than $24.12 next time, because it will include these 40.21 shares on top of the, I think, over 1,000 shares we have. We'll see our position here in Medical Properties Trust, but as you can see, we're starting to get a significant trounce of new dividends whenever we get, or new shares whenever we get dividends paid out here. Now, finally, to the first new capital added to the portfolio, we did add $1,361.34 on July 8th. With those funds, this was the majority of our purchases as well. With those funds, we picked up 2 more shares of Alibaba Group, ticker BABA. We picked up those 2 shares at $73.25. And Alibaba Group is a Chinese company. So again, maybe some tax implications around this one for you to work out with your brokerage, or to make sure you understand at the end of the year. My brokerage takes it out right away. And this is one that we were just nibbling on a little bit because it was below our cost basis. I think by the end of the week it was well over our cost basis, so I may not be adding any to this, but I wanted to take advantage of that dip back down below our cost basis. This is our, and BABA is out of the consumer discretionary sector. Union Pacific, there's that railroad company again, out of the industrial sector, ticker UMP. We added 1 more share there. So not only did we add to this in our reallocation of funds, but we picked up 1 with our new capital as well. That 1 share we picked up at $224.60. We added 2 more shares to our Comcast Corporation position. We added those 2 shares at $37.96. And Union Pacific, Comcast, and Cisco Systems are all on our stocks to buy for July. So we're really focusing on these for the month of July anyway. But you can see here 2 more shares of Comcast Corp at $37.96. This is out of the communications sector. 2 more shares of our Cisco Systems position here to add to that one. Ticker CSCO. We picked up those shares at $46.78. This is out of the information technology sector. Nutrien, one that really dropped down under $50 there. I wanted to pick up a little bit here as well. A lot of companies really pulled back here. By the end of the week, they had all rebounded nicely. As you'll see here, my portfolio was up significantly, but a lot of the companies didn't start that way this week. So I was glad I made a lot of my purchases early this week, because like I said, by the end of the week, I think this was in the 50s, back in the 50s again. 4 more shares of Nutrien. This is a company out of the material sector, also a Canadian company, so some tax implications around this one. Ticker NTR, $49.85 per share there. 6 more to our Starbucks position, ticker SBUX, out of the consumer discretionary sector. Finally, over 100 shares here. We've been building this one out for almost 2 months, maybe a little bit over 2 months now. So just crept over that 100 share mark. Picked up these 6 shares at $76.13. And Haverty Furniture Companies, we picked up 7 shares there, ticker HVT, out of the consumer discretionary sector at $23.51 per share as well. All total, this $1,361.34 and the new shares it added to the portfolio added an additional $45.48 in additional income over the next calendar year. And we weren't done. So since we picked up the SCHD ETF shares earlier, 1 out of new capital and the other 5 out of the reallocated funds, we're not showing it here at the end of the week, but on the 12th, we did go back in and buy our other weekly ETF that we've been adding to regardless of what the market is. Right now, I feel like I'm paying more than I should be, but the market's hitting all-time highs almost every week. So that's just the way it is. This is every company inside the United States, New York, on the New York Stock Exchange, every company in the New York Stock Exchange in the United States there, ticker VTI. This is the Vanguard Total Stock Market ETF. That's just what it is. All the companies in the stock market. Picked up that 1 share at $275.64, and this 1 share added an additional $3.66 paid out over the next calendar year. Total invested $1,706.91. Total passive income added with the dividends, with the reallocation, and with the new capital, $90.44 added in passive income to the portfolio this week. Very nice to see that. Not quite over 100, but we're a very, very good week. We've been adding around $40 to $60 a week here over the last several weeks. So it was good to see a week where we had above average. Now we're going to run through the sector weights here. Communications sits at 9.94% of the portfolio. Consumer discretionary at 7.2%. Consumer staples at 9.23%. Energy makes up 5.93% of the portfolio. Financials sitting at 6.26%. Healthcare, largest chunk at 14.13%. Industrials makes up 6.48%. Technology sitting at 7.09%. Materials at 8.92%. So even though we sold out of, and that was part of the reason too, I felt like my materials position was getting a little bit up there. As far as of the positions in the portfolio, it's not one that I really want to be in the double digits. So that was the other reason for the kind of the sell of the Sibanye-Stillwater. And that could be another reason for selling. If you have a hard and fast rule where you're willing to take profits, another reason to sell is to take profits. Obviously, we didn't get profits from Sibanye-Stillwater. But if you have when I hit 80% profit, I'm going to sell. If you have a rule in your portfolio that's what you do, that's a good reason to take profits. Or like I do, if you have a rule in your portfolio where you don't want any one sector to be over 20% of the portfolio and it gets too high and you sell out of some positions to do that, that's another good reason to sell. Right? Or if you have a rule about single positions. I don't like any one position to be more than 10% of the portfolio. So that would be another reason to sell. So there are some reasons to sell, and again, I think that deserves its own video, and I'll try to get one over the next couple of weeks. It's tough with kids. Painting my daughter's bedroom right now, so my weekends are pretty well spent trying to spend some time with them and paint her room, and then I'm off to painting my other daughter's room here right after that. So busy summer for me. But anyways, technology, I think we stopped off them at materials at 8.92%. Even with the sell of Sibanye-Stillwater, it's still, very well diversified portfolio overall and still one of the larger positions or one of the larger sectors here. Utilities makes up 10.01%. REITs, is the still second place, 10.9%, though some of the other ones are catching up here at 10.01%. Utilities isn't far off. And ETF still makes up this smaller slice at 3.92% of the portfolio. Now over here on the right, you can see the same sector weights broken down by the percentage as the pie, but also the dollar amounts allocated to each position as well. Now here it is. I show this every week. Now, one of the reasons I set up this channel, well, there were a couple reasons. One really was that I saw a lot of, I'll just call them clowns on the YouTube here, pushing a lot of crazy stuff, stocks that they think would never go down, stocks with PEs in the 50s, 60s, 70s, projecting out growth in the 50, 60% growth every year for decades to come, like the Teslas of the world. I think NVIDIA meets that criteria right now. Some of the other companies that were being pushed by people with ungodly expectations really rubbed me the wrong way. So I thought I'd put a channel out there to bring a little sanity to this space. And the other reason is not a lot of people were showing their portfolio. Everyone was trying to charge you for courses, or if you wanted to see their portfolio or what they're buying, you had to sign up for some paid Patreon, or you had to go to their website and sign up, and then they'd send you, links and stuff to where you could see what they're doing. You should not be paying these people to see their portfolio. They are not professionals. They say they're not professionals. I'm not a professional. So why aren't they being transparent out in the open? And if they want to sell you a course, they should be proud to show their portfolio, right? You shouldn't have to pay for that before you see how well they're doing, right? I'm not trying to sell you anything. But I think it's important for people who, especially those who are just starting out, to see a real portfolio built out over time. You can see the ups and downs in the market. You can see the different positions go up and down over time. That's why companies have a 52-week low and a 52-week high. And they could easily go from a 52-week high back to a 52-week low. That's just how the stock market and how companies work over time. So I'm going to continue to show my portfolio every week. Full transparency. You can see what I'm buying, what I'm selling, any reallocations I made, just like I showed you here, any options I'm into, out in the open, nothing to pay for. We all have enough to pay for. But I want those of you out there that are just getting started or who are thinking about starting a portfolio to see a real portfolio built out over time and know that you can do it too. Maybe to give you some confidence to get started if you haven't started, and maybe to give you some confidence to keep going if it's maybe taking a little longer than you thought, or you're seeing some red in your portfolio and starting to freak out a little bit. That's okay. When I see the red, those are the times that I look at, okay, those are buying opportunities. You don't walk into a store and see a sale and then run out of the store because something is on sale. Typically, what you do is you go in and you buy what you were going to buy anyway for cheaper and maybe buy more of it, or use the extra funds and buy something else that you wanted to buy. The stock market seems to be the only one where people see something in the red and they freak out and want to sell it. Right. Again, I look at those as buying opportunities. So hopefully seeing this from an average person, I didn't go to school for finance. I don't come from a family with a lot of money. Neither one of my parents even graduated high school. So if I can do it, you can do it. And that's why I show my portfolio every week. Hopefully you appreciate that. But let's keep rolling here. I think I'll jump off my soapbox and get back to the video. Here you can see all the different positions. Here's the tickers here in this column. All the total shares, how many shares I own of each position, current price as of the close of business on Friday, the market value as of the close of business on Friday, my average cost per share. So this is what I have into each position, right? How much I paid per share. Whether I'm up or down, you're going to see in the purchase price, so how much money I have into each position. On the previous page, you saw how much I have in each sector. This is by position. Total return. The next two columns are going to be total return, whether I'm up or down. If I'm in the red, you're going to see it, right? Green means I'm in the positive. Red means I'm in the negative. What sector each company falls in, whether they're a quarterly, monthly, or semi-annual payer. Current dividend yield as of the close of business on Friday. My yield on cost. The portfolio weighting. So what we saw on the previous slide was the sector weightings. This is each individual weighting. And like I said, I do have a rule in my portfolio. I don't like any one position to be over 10%, and I don't want any one sector to be over 20 to 25%. Now, there may be some reasons that temporarily a position might go over. Let's say a position runs way up. Johnson & Johnson, for example, it's pulled way back. Let's say it runs back into the 170s where it once was, or 180s even. Well, then this is probably going to get pretty close to 10% of the portfolio. That doesn't necessarily mean I'm selling, but I definitely won't be adding at that point, right? So I might just add to other positions, and then as the portfolio grows, it'll make that percentage go down naturally. Now, if it was to run up to 20, 30%, I would probably look to trim some of the position down a little bit and take some profit, with the idea that eventually it will probably drop back down. So if a company artificially goes up and it's just on a run for no real reason, other than people are dumping money into it to make it run, then I may take some profits. But if it's just up a little bit and it hits 10%, I probably would just back off and add to other spots. Estimated annual income here, payout months here, dividend growth year over year here, and where it sits at 15% of a 52-week low. I think I've beat this one to death, but if you're new, this basically gives me a high watermark of what I want my average cost per share to be, right, in this column. So I don't want, for example, Ally Bank. It's way up, and I really can't add to it because it's up so much, and it would drive my cost basis, which is just under where it sits at 15% of a 52-week low. I would drive it over this 25.92, right? BABA, the same thing. Now this is one where, see, the average cost per share is 75.40. 15% of a 52-week low is 76.62. I might nibble a little bit, so long as it's at 79.65. So it's not so far above where it sits at 15% of a 52-week low. It probably wouldn't bring my average cost per share over this. So I could probably add a couple more shares here, especially if this dropped back into the 78 or 77 range, and still be over my average cost and still be over my 15% of a 52-week low, but not drive this number above that. Hope that makes sense. Drop a comment down below if that didn't make sense. I'll try to explain it a little better. So total shares, 6,389.76 shares. The market value of the portfolio, very good week this week, sits at $269,779.52. Purchase price, I have $254,657.95 into the portfolio. I am up $15,121.57. If I was to sell everything right now, I could walk away with a little over $15,000 in profit, up 5.94%. But I'll say it, even when I'm in the negative, I say the same thing. So I'll say it while I'm in the positive. I don't focus on this. This is not I'm not looking to sell out of the positions in my portfolio. Although I did sell out of Siboney-Stillwater this week. I'm at overall. I'm not looking to sell out the totality of my portfolio. Current yield as of the close of business on Friday, 4.296. My yield on cost, 4.552. And that's why it's circled in red. This is what I focus on. The dividends paid out from all the positions inside the portfolio. The passive yearly income sits at $11,590.88. Getting ever so close to that $1,000 a month range, or $12,000 in estimated annual income. I don't think we will hit it by the end of July. We'll be pretty close, but we'll definitely hit it sometime in August. If not the first week, probably the second week in August there. Dividend growth sits at 5.93% over year. And that is the update. Let me know what is going on in your portfolio. Like I said, it was a very good week in my portfolio, up significantly. I think we were hovering around up $7,000 to $8,000 and basically doubled up this week. Even though, as you see, I still have some red. So where do you think I'm going to be adding capital to next week? Outside of Union Pacific, maybe nibbling there, maybe nibbling on Procter & Gamble. Everything else I'm looking to add to right now is probably something in the red. Comcast and Cisco still in the red, so I'm definitely going to be adding there. CVS, I wouldn't mind adding a little bit more there. Enbridge, you saw me add 10 shares there in the reallocation. I wouldn't mind adding some more there. Kraft Heinz, believe it or not, I may actually add a little bit there. MPW, I have 1,152.758 shares. It's flipping out 40 plus shares there that you saw when it pays out dividends. I have not been adding to this. I did nibble a little bit last month, but it's just pushing out so many shares right now when it pays dividends. I'm just going to let the dividends do their thing, even though I am down significantly on this one and could lower my cost basis a lot by adding to this. There's just other positions I want to add to right now instead. Nutrien, again, I added a little bit this week. Wouldn't mind continuing to build that one out, get it to 200 shares. Kraft Heinz, wouldn't mind getting to 200, 220 shares. Haverty, I wouldn't mind doubling up this position, to be honest with you. I wouldn't mind making this 2 to 3% of my portfolio since it's so low. It's only 1.12% of the portfolio, right? Very high dividend yield right now, over 5%. Could bring this up to 4.6%, 4.7% dividend yield on cost there. Wouldn't mind doing that and bringing this up to 2%, bringing that to 300 in estimated annual income. Not going to do it all in 1 week, but I wouldn't mind continuing to add to this one while it's down. Same thing with Pfizer. I might bring this up to 300 shares. You know, I'm not looking to add a lot, but wouldn't mind crossing over that 300 share mark. Starbucks, this is another one. I could probably add some more here. I wouldn't mind having $10,000 invested into Starbucks, 10 to 12,000, so I wouldn't mind adding there. And Valet, that's another one that I may be adding to next week as well. Get that over 400 shares and continue to bring this cost basis down, right? The 13, I wouldn't mind getting back into the $12 range for my average cost per share. Well, there it is. Let me know how your portfolio is doing. Like I said, when I see the red, those are buying opportunities. Don't freak out. If you did the research on the companies that are in your portfolio, they still meet the criteria you set up, and they pull back, those should be buying opportunities. If you look at it as a sale, right? If you go into a store and see a sale, you don't run out thinking that the product you were going to buy is junk just because it's on sale. Keep that in mind. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And let me know how your portfolio is doing. Was this a good week for you? It was a great week for me. I don't necessarily want these type of weeks every week because I do like to buy shares cheap as possible. But it is nice to see the portfolio back significantly in the green as well. It does give you kind of a mental boost, right? That's part of investing, that mental aspect of it. But I'll be looking to probably continue adding to those positions that are down. What are you adding to your portfolio? What are you buying? Have you sold anything lately? What was the last stock you sold? Or are you thinking of selling one now? And why would you sell it? Why might you hold on to it? Well, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great weekend, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risks. You can lose money and should never invest any amount you're not comfortable losing it. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.